Good afternoon, everybody, and a warm welcome to Reverse Mortgages. I think you'll find out. I can't emphasize this enough. This is your time to get out and tell people about this that are eligible 62 and over. And I'm telling you, because who knows what's going to happen with Social Security? You just don't know. This would help them stay in their house. So, and give them money, especially if they've already paid off their loan. So please pay attention carefully because I think this is a great lead in for all of you to get business. Okay. Or at least business from them. They're not moving, maybe, or maybe they're going to use this to buy another house.
Mhm.
Whatever it is, this is a real goodwill effort. Okay. I mean, I really feel that strongly about this program. I'm Cindy Bishop with Cindy Bishop Worldwide, and it's a pleasure to introduce our esteemed master instructor for today, Kelly Katalinas. Kelly is a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production and cultivating lead generation. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by Washingtonian Magazine. Additionally, she has received the 5-Star Professional Award for the fourth straight year, which was bestowed upon only 3 out of 4,600 individuals in the Washington, D.C. area in 2024. These are just some of the many professional awards and accolades that Kelly has received. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents, with over 95% of her business coming from referrals. Today, Kelly's going to share her expertise on reverse mortgages. So, without any further ado, please join me in extending a warm welcome to Kelly.
Thank you so much. I'm so happy to see everybody here today. I'm glad you could take a little bit of time to join me for this. I am incredibly passionate about this particular topic, reverse mortgages, and just as we go through, this is being presented as though I would present it to a consumer, okay? There is a niche, obviously, for real estate agents in terms of, yes, you can purchase a new home and do a reverse mortgage for purchase. We call it an H for P, a HECM for purchase transaction. So obviously there's a market here on the real estate side in terms of sales, but I believe to be effective in that sense, you have to have an understanding of the program itself and how it works, because it's a lot of conversation about features and benefits and understanding your client base as they move into retirement age and their goals with their retirement. So we're going to walk through a lot of slides. We have a small group today, so I would say if you have a question, just unmute and ask the question or put it in the chat and I'll monitor that as well. And hopefully, some light bulbs will go off as you go through with this. So what we're going to talk about is we're going to introduce the program. We're going to talk about what goes into the qualifications for a reverse home loan. How can you use it? There are many ways you can use the funds from a reverse mortgage. What happens to create a maturity event? And then fairway, that's a quick one. Really, it's why use fairway. We're one of the largest reverse lenders in the country. So we'll move into the presentation now. So again, we're going to go through a little bit about reverse mortgages. And typically, when we ask our clients, what is your opinion of reverse mortgages? It's either they're great, or I've heard some bad things about them and I'm here to learn the facts, right? We might even hear someone say, "Oh, they're not very good." And I would say to that, you're living in the past, okay? The reverse loans today, specifically the one we're going to discuss today, which is the FHA home equity conversion mortgage, a government insured program because it's FHA, has the most consumer protections in it to protect that client should they engage in a reverse mortgage. So we're going to go through that. If you've never read any of Wade Fowle's books, he is a very strong proponent of how using a reverse mortgage strategically can extend and improve the sustainability of your retirement income. Everybody as they start aging is worried that they're going to outlive their resources, right? Nothing is getting less expensive. Things are getting more expensive. So, as Cindy was saying before the call started, you're watching your nest egg go up and down based on what the market is doing, and you're trying to hedge against losses, that you might be incurring in that retirement earnings. So again, he's got a lot of books out on reverse. You could look it up online too, but talking about it, and we're going to get into some statistics as we go through this too. Generally, you'll see that strategic use of reverse mortgage can extend that retirement portfolio. So again, if you're 62 and older and concerned about market volatility and inflation, outliving your savings, how you're going to make your monthly mortgage payments in retirement, and not being able to continue to live in your home in a safe, sustainable way, this could be a good solution for you. More and more of the boomer generation are not selling, right? They either have a very low interest rate, they either have no mortgage on their home, they don't know where they could go, and or might not want to sell that house and liquidate and pay cash for something else. They just like their home and they want to adapt it perhaps in age in place. This could be a way to give them what they need to make those adaptations to the home to make it sustainable for them, and age in place. A reverse mortgage loan is exclusively for adults age 62 or older. Okay. And what it does is it converts a percentage of that home equity into tax-free cash. Okay. So I want you to think about how your credit card works, right? A reverse mortgage works similarly. If you buy something on your credit card and you do not pay it off next month, you're going to owe interest on that balance the following month. Okay. A reverse mortgage negatively amortizes exactly like that. The only thing is it's got much better interest rates than any credit card would have. Okay. And protections in there too. You are not required on a reverse mortgage to make the principal and interest mortgage payments. Doesn't mean you can't, right? And for our real estate friends who might not know how the year is going to go, we have realtors that will go on to a reverse mortgage, not make a principal and interest payment all year. Okay, see where their commissions land. When they get to November, they decide on if they're going to pay against the reverse mortgage to keep the balance at a certain level. And I say November because if you're going to pay principal and interest, you want to get that interest statement in for the next tax year, right? So you want to do it definitely prior to the end of the calendar year for tax preparation reasons for next year. Your real estate property taxes and insurance must continue to be paid, just like on any regular home mortgage. They are not escrowed on a reverse mortgage. They are paid separately by you. Okay. The reverse mortgage strictly just handles everything relating to the loan. It does not handle anything related to homeowners insurance or property taxes. So the reverse mortgage I want to talk about today is the home equity conversion mortgage, or HECM, affectionately is how we call it. It is the most used reverse mortgage in the United States. About 95% of all reverse product is on the FHA HECM loan. It launched in 1989, but it is way different than when it first launched in terms of improving consumer protections within the program itself, not just for the people who undertake the reverse mortgage, but for the heirs who might inherit that property, upon a maturity event. Okay. It, like, as I said, it's insured by the Federal Housing Authority. And again, you have to be 62 years of age or older to be eligible for it. So, this is debunking some myths with respect to reverse mortgages. Many people think a reverse mortgage is just a loan of last resort, that they're in a situation where they've exercised all of their retirement assets. The one asset that remains is a house with little or no mortgage remaining on it. And that is the primary reason to get a reverse mortgage. That couldn't be further from the truth. While it can meet the moment of a last resort situation, there are many affluent older adults who are living longer, okay, who will use a reverse mortgage instead of liquidating and paying tax on investment earnings in their portfolio. Distributing from a reverse mortgage is a tax-free event because it's your loan, it's your money, it is not taxed. Okay. So the reverse mortgage can address need, for pay things for like paying for in-home care, which is rising all the time. Lifestyle enhancement, paying for things not in the budget. Maybe you don't like the idea of debt, but you like the idea of traveling. And again, based on when you travel, you might not want to pay the expenses of the travel by liquidating a taxable account that you have to pay tax on that and then spend money to pay travel, right? So again, it could be for anything outside of the budget. And you can use it in financial planning, right? You want to maximize cash flow, reduce tax, and minimize your risks. Okay. And we're going to talk about a few examples as we go through. So again, pros and cons, right? It's an extra source of cash flow. Some people, when they go into the retirements, might only be working off a pension or Social Security and may not have a nest egg, but they own their home or they have a lot of equity in the home. Okay. This can be an additional source of cash flow so that on a monthly basis, they are living the way they would like to live in retirement. Again, you can extinguish the principal and interest payments by replacing any current mortgage with a reverse mortgage that doesn't require principal and interest payments to be made. You still have to pay the taxes and insurance and maintain the home, right? You can't let the home fall into disrepair. And it's a non-recourse loan, and I'm going to define that in the coming slides. Okay. So just keep that in mind. That is a very strong word, non-recourse loan. The cons are obviously there's a minimum age requirement in order to do this. You're chipping away at your home equity. There's no easy way to say that. If it's negatively amortizing, your equity is shrinking, right? But is it shrinking faster than it's appreciating? Maybe, maybe not. Okay. So again, everything is done to preserve that equity position as you go forward, but there are fail safes should that equity position not be preserved for our clients. And these are only for primary residences, no second homes, no investment properties. It's an FHA loan. Okay. Owner occupied only. So let's talk about some of the myths, right? The bank will own my home. This is absolutely incorrect. Just like you own your home today, you are on title, you make decisions about your home, whether to sell it, keep it, etc. If on your current home today, you don't have a reverse mortgage, what happens if you don't pay your property taxes? Right? A lien gets placed. Maybe the county starts foreclosure proceedings. That would be the same on a reverse mortgage. If you didn't pay your property taxes, there's, you know, an opportunity there for foreclosure. It's no different. Okay. You're still entitled on the home. The bank does not own it. All right. You or my heirs will be stuck with a big bill. That's absolutely not true. You or your heirs will never owe more than the value of the home after the loan matures or the home is sold. So let's talk about that. Let's say the house is worth 400,000. And at the time the reverse mortgage comes due, meaning someone has passed away or both who was ever on the loan have either passed away or moved out of the property altogether, like never to return. Maybe they moved to assisted living or whatever. That's a maturity event. House is worth 400,000, you owe 450. Okay. You could give that house back to, and we're going to go through this. You can give that house back to the bank and the heirs and you will never be on the hook for that deficiency of $50,000. Okay. This loan has mortgage insurance monthly that is assessed on the loan every month. That mortgage insurance fund is designed to handle situations like this. Okay, so it never comes back to the homeowner. It never comes back to the heirs who might be inheriting the property.
Hey, Kelly,
Okay.
you may not know the answer to this, but Anne had a really good question, and I have the same one. Everything I own is in a trust
Mhm.
because I want it to be easy for my kids.
Yeah,
So
you
my
can do it.
mortgages, so my houses are too. So can that, I'm the only trustee now,
Yeah,
and then they're the beneficiary. So you can do it in the trust?
absolutely.
Wonderful.
We just have to review the trust to be sure it's revocable, not irrevocable.
Okay.
Okay. So just like on the forward side, we would get a copy of the trust and just send it in for approval, and you can take title in the name of the trust. Sure.
Okay.
Mhm. You have to own the home free and clear to qualify. Absolutely not. You have to have a significant amount of equity. And the younger you are, the more equity you need. So as you get older, the less equity you need. Okay. It's all done in actuarial tables and value of the property in terms of assessing what's the maximum loan. Generally speaking, if you're 62, you need about 60% equity in the house. Okay. If you're 70 or 75, it's less, it's closer to 50% equity. Now, as interest rates improve, that changes a little bit. Okay. You can get more. When interest rates are lower, you can get more on the loan, but when interest rates are higher, you get less. An appraisal is the key component to it's an FHA appraisal. It is the key component to what the maximum mortgage is on a reverse loan. Okay. Sometimes, and don't ask me why, when I had one last year, we did an appraisal. And when the appraisal came in, there were questions on it, and a second appraisal was required. So sometimes two appraisals are needed, both FHA. The lower of the two will typically be used. So I can't tell you when a second would be required. In this particular case, the house was built in 1930. And I reached out to underwriting on that. Why are we doing two appraisals? What's the reason? You have questions on this, whatever. They're like, there's inconsistencies in the valuation. We need a second one. That's all I can tell you. So just understand it could be 1 to 2 appraisals needed on it. And it doesn't tell me up front whether or not 2 would be, we have to order 1 first and then go from there. Again, you have to have sufficient equity, and the existing mortgage, first and second trust, if you have a HELOC or whatever, they have to be cleared and paid off and replaced with the reverse mortgage if you're going to use a reverse mortgage. You can't keep that equity line on it. Okay, because you're moving everything into reverse scenario and the balance is going to grow over time. All right, let's talk a little about loan qualifications. Again, 62 years, have to be the homeowner, have significant equity or own the home outright, primary residence, and you have to meet minimum credit and income requirements. Well, we'll get into what that means here, right? Eligible property types are single-family homes, 2 to 4 unit properties where you live in one of them, townhomes, condos that are FHA approved. If it's not FHA approved, it could be possible that we can get a 1 unit approval. We have a big department at our company that works on just condo approvals. Plan unit developments, modular homes, and manufactured homes that meet FHA requirements. So pretty broad. We don't do co-ops. I had that question from somebody last week, oh, it's an FHA, they want to do a reverse. I'm like, no, reverse co-ops are not allowed on reverse loans. So here's an idea, and this is using an example of 50% home equity. $400,000 home value, 100,000 mortgage, you have 300,000 home equity in the property, which is 75% of the market value. We have some borrowers that if they were short in terms of the equity that they needed to do the reverse, they can bring cash to closing just like they were purchasing the house again in order to do the reverse. Okay, so we do have some people that do that just because they want to get out of paying or being required to pay payments every single month. So again, how much money can you get? It depends on the age of the youngest borrower or non-borrowing spouse, right? So again, we're going to go into this on the next page. It depends on the interest rate you get on your loan. If we have better interest rates, there's more money that we will lend, right? As rates go down, the lending capacity will move up. And the cool thing about reverse mortgages, even though it's an FHA loan, the loan limit is the high balance limit across the United States. So whereas FHA lending limits vary by county, some areas are high cost areas like the DC Metro, which would be this high cost limit you're seeing here. For the reverse mortgage, they set the maximum reverse mortgage to the high balance limit all across the country. So we've had some questions from people who own very expensive properties. They're self-employed. Maybe the house is worth $3 million and they want to take out a $1 million reverse loan just to stop making payments on it. They've got this huge amount of equity in it, and they would rather just keep that money invested and use it a different way. We've had that question fairly recently on the very high end market too. So when you think about it, it's not just about, you know, people who are in dire straits or in a last resort. Very wealthy, affluent borrowers are looking at this as a financial tool. So let's talk about how much money, then give you an idea here on this example, right? So the PLF stands for principal limit factor. That's something we need on the lending side to determine how much of the mortgage we can lend. So in this example, we would take the youngest borrower's age at 74. And let's say the expected interest rate was 5.5%. So if you're looking at the chart, you're going across from 74 over to 5.5% to get this principal limit factor of 45.8. Okay. The value of the home is 600,000. So when you take that 600,000 times that factor, the available loan proceeds are 274,800. Okay. And you can see as you get older, like at age 76, that factor is higher. Okay, we would multiply it by 47.30 at 5.5%, and that loan proceed balance would increase. Any questions before I go into this? Using the reverse mortgage? Anne, are you asking a question?
Yeah, I clicked on the wrong thing there.
Yeah.
You didn't need my picture. If you get a reverse mortgage at a certain rate and the general mortgage interest rates go down, does your rate remain consistent? Is it fixed or does the rate
No.
also?
It's a line of credit. So the rate is going to go up and down every month. Just like a home equity line of credit would work, this one works in reverse. So it will go up and down.
Thank you.
Yep. Okay. So how can we use a reverse mortgage, right? Well, basically, there are three buckets of wealth, right? Let's look at the traditional methodology. When you're starting your work at 18, and let's say you're ending it at 62, right? We've got the first bucket, which is your monthly income. You've got your wages, your commissions, pensions, Social Security. This is where you're getting your income on a monthly basis, right? Well, at age 62, earned income might be decreasing as you consider retirement, right? Because you might stop working and just rely on pension and Social Security. Your second bucket is that nest egg, right? That's that 5 to 20% you may have saved for retirement. It's comprised of, lump sum savings, life insurance, IRAs, 401ks, stocks, bonds, mutual funds, anything you might have put away and set aside for your retirement years. And then you've got your home equity, right? Which is all the equity in the property that you have that's not working for you. It's sitting there, it's an asset, right? It's a great bottom line figure, but it literally is just air. Okay. It's not helping you on a monthly basis. It's either going to help your heirs or it's going to help you perhaps when you sell it and move to the next property, right? But until you do something with the house, it's just sitting there, right? So, there's traditional spending sometimes continues, right? You don't change your habits necessarily so much in your retirement. You might have to learn to because your budget changes. But the concern is always about, should anything happen health-wise, should medical costs go up? Where is that money going to come from and have I planned accordingly? Okay. So let's talk about how we can use a reverse mortgage. You can do it as a single disbursement and a lump sum. You can do it as fixed monthly advances. You can keep it open as a line of credit and only draw on it when you want, or you could do both. So as an example, and I talk about my mom every time I do this call. My father passed away in 2006. In 2008, my mother had owned her home. They owned the home free and clear. She's 93, by the way, and going strong, going to be 94 in August. And, Social Security got cut in half. I came from very humble beginnings. My parents had very little in retirement. They were living off of Social Security. And at that time, Social Security gets reduced and she wanted to age in place. She was in great health. She's still in great health. So we put her on a reverse mortgage in 2008. At the time, my childhood home was built in 1910. And she wanted to put a new roof on we had a standalone garage, a new roof on the house, and do some other things. And she wanted a disbursement monthly. Okay, so we set up the reverse loan. She wanted 35,000 in cash, and she wanted a monthly stipend of roughly 13 to 1,500 a month. We sold that house in December 2024. And only because we had someone make a great offer on it. It needed a lot of work and updating. And she didn't really want to put any more money into the property. And it was a way to sell the house and walk away. So even after all that time, she still had equity remaining in the property and was able to profit from the sale. But in the meantime, in terms of distributions that she took over the course of those, 16 years that she had the reverse, she dispersed about 275,000 in tenured payments to help her with her monthly living and let her do things she wanted to do in a regular way. So yes, it went against her depression era mindset from the standpoint of let's own this home outright, the pride that comes from owning the home. And her children looked at her and said, you're in great health. We want you to enjoy your retirement. You're in control, here. And it really just got to be to the point, my sister really just wanted her to move in with them and just say, we don't want to worry about you alone in this house anymore, and here you can make some money off of it and still do whatever you want to do. So there's a lot of ways you can use a reverse mortgage. That's one way, right? A lot of other people can look at this, as I mentioned earlier, as a hedge against using other investments. So to give you an example, let's say you have $100,000 mortgage loan that you're replacing with a reverse mortgage. And let's say at the end of the first year with negative amortization, maybe your balance is 110,000, let's say, well, if it's 110,000 after the first year, by your investments that you have in your 401k and IRA made you $20,000 at the end of that same year, why not take 10,000 out of it and pay it back down to the 100? You still made more money over here. So if your financial planner is investing your money and making 10% or 12% or whatever in earnings on your portfolio over here, right? And you're using your reverse mortgage as a stipend and living off of it and not making those mortgage payments perhaps over the course of the year, it doesn't matter where the money is in the end. It's just that there's more money in the end. And that's the point, right? More and more people are looking at how this is a savvy investment move where you have control over what you're using in retirement. Okay. So some advantages of the HECM, and I don't know why there are red marks on here, probably because I'm waving. I don't know. Advantages of the HECM line of credit is the unused portion grows over time, and it grows at the same compounding rate as the loan balance. So while my mother started out, let's say her mortgage line of credit might have started out at, let's say, 175,000. 16 years later, that line of credit limit was like 455,000. So it grows over time. If she had paid it back, like let's say she dumped 200,000 against it, she still would have had access up to that 455. It's never decreased like traditional home equity lines could happen. Like you could have a bank come back and say, oh, remember we lent you $100,000 equity line. Properties have gone down in your zip code, so we're reducing your equity line to 50,000 now. That cannot happen on a HECM. Okay, once it grows, and it stays that high no matter what. They're not going to come back at you and reduce it. There was a question. So the HECM is only FHA. The home equity conversion mortgage is an FHA loan. There are no VA reverse mortgages that I am aware of. There are conventional proprietary reverse mortgages where they're usually for higher end kind of loans above this limit. Sometimes the age requirement is reduced. They are state specific. They're not all nationally available in all states, but we have a couple that are proprietary that we can look at that are conventional. This just happens to be the most secure and have the most protections for the borrowers. It has greater capacity, borrowing capacity over time. It, like I mentioned, it's secure. The line of credit cannot be capped, frozen, or eliminated due to any market conditions. And it's liquid. You can borrow against it, pay it down, and borrow again. Just like a line of credit, the only difference is you are not required to make a principal and interest payment monthly. But you can reuse it 1,000,000 times. So this just gives you an example of the line of credit growth. Let's say you started at 62 years of age and you put a reverse mortgage on your home. Your value was 600,000. At the time, the line of credit was 223,506. Well, 27 years later, the estimated home value is 1,024,000. And your line of credit is 1,026,643. So it doesn't matter that the value was lower than the line of credit. It just doesn't matter. It will continue to grow. You can use the reverse mortgage to, again, extinguish your current mortgage and replace it with a reverse. And again, you have to make your property and insurance payments outside of the home loan. You can use the available credit line as standby portfolio protection, as we've talked about. Some people use the reverse mortgage in economic downtimes so that those investments can stay put longer and last longer over time. You can, again, close that financial gap. So, I'm going to be 62 in September. And for those people my age, they keep moving the needle on when the maximum benefit for Social Security comes about. For me, it's age 67 now. Okay. When I started working, I can tell you it wasn't 67. So a lot of people who had plans to retire at 62 or 65 are now sitting here going, well, wait a minute. Now I've got to work longer, or can I use this reverse mortgage as a way to retire when we had planned to retire, and maybe use it to pay for those insurance premiums that I need to now buy on my own until I could get to Medicare eligibility, right? I don't want to go into my portfolio to pay for those higher insurance costs, but I want to retire. We're healthy. We want to do things. We want to retire. So a lot of people look at the reverse as closing that Social Security or pension gap time until they can get into those ages for Medicare. Maybe you want to help your family now, you want to donate to charitable organizations, you want to give gifts to help one of your grandchildren or children buy their first home and use it that way. Or you want to create nest eggs for grandchildren or college funds or whatever it might be. A big thing that people are using reverse mortgage for are home renovations and in-home care, right? Those are increasing premiums. Long-term care insurance premiums are increasing. Here's an example of what the average costs of long-term care are. And you can say, okay, home health care, you've got to plan about $60,000 annually for Alzheimer's care, meal prep, diet monitoring, housekeeping, errands, or shopping. If you go into assisted living, right, one of you, let's say, you're still in your home because you've got to be in the home to get the reverse, but maybe you need one of the borrowers has to move to assisted living. That could run 54,000 annually for private apartments or on-site nursing, daily living, help with medications, whatever. Full-time nursing home care, if one of the owners or borrowers has to move to full-time nursing care private, that's a huge number at an average of 108,400 annually. So like you just don't know what's going to happen. So it's just letting you know that this is an additional tool in your toolbox should any of those circumstances arise with one of the borrowers on the home. And again, Medicaid only pays for shared rooms. 95% of people have no long-term care insurance, and over 50% are going to need it. So it just gives you something to think about. You can also use it for financial planning to try to keep your adjusted gross income low. Some people want to continue to work and not perhaps take their Social Security yet, but they need extra money monthly, or they, might have one-time expenditures. So for example, maybe you're okay with where the income is, but you don't want to have a higher tax bracket by earning above a certain level. Okay. You might pull from the reverse mortgage to use that a few months out of the year to keep your income within a certain tax bracket. Whatever you disperse from the reverse mortgage is not income. It is not considered income. It is cash to you, non-taxed, because it's a loan. It's your money. You're just taking it today. So again, it's a hedge against market risk or any sequence of returns on risk. A hedge against long-term care costs, and again, maximizing other retirement contributions. So there's always like a strategy. Why should I do this sooner than later? Okay. Well, let's talk about this. Why 62, not 82 might be the best time to secure it. So under Sachs and Sachs coordinated strategy says, if you open the line of credit early, your cash flow survival rate of your retirement funds is about 78%. Okay, that assumes that you're taking 4% out, withdrawal rate annually, which is kind of like the basis, like don't exceed 4% withdrawal based on a 32-year investment return. So that's assuming you're 62 and you're going to 94, right? So 32-year investment return. Home equity as a last resort, conventional passive strategy. If you delay opening a line of credit until you deplete your other investment portfolio, your cash flow survival rate drops to 60%. Again, that assumes the 4% post-tax initial withdrawal rate. Okay. If you do nothing with your home equity, okay, you do nothing. Your cash flow survival probability, assuming again that 4% initial withdrawal, is 35%. So it just gives you a sense of how you can extend your retirement savings by how to use the reverse mortgage earlier rather than later. Does it include the mortgage insurance? So mortgage insurance, Anna's saying in the examples that you showed, does that include FHA mortgage insurance? Mortgage insurance is a 0.5% monthly on the loan. So it will increase as the loan amount increases. Okay. So it's like having monthly MIP added to your monthly loan balance each month over and above whatever the interest cost is being added each month. I hope that answers that. And this just is a visual representation of what we just talked about. You know, strategies that open the HECM line of credit early, but then delay its use for as long as possible. That's a strategy because it's going to continue to grow over time, you know, as the property increases over time. It has top consumer protections, okay? You have to receive counseling from a HUD approved agency. So if I were to do your reverse mortgage, we would put you in touch with a bunch of agencies. A counselor comes to your home, meets you. And because of elder abuse, we want to be sure that you understand everything that is happening on the reverse. Okay. We don't want there to be any confusion about when you start going down the path. We look at what are the initial disbursement limits, and there are some disbursement limits. You can't get all of your cash in the first year. There's a limit of how much cash you can take in year one, and then the rest of the cash available to you opens up after the 12th month. The reason for that is in the past, there were abuses. You had people taking out a reverse mortgage, getting all the cash out of it, and then not paying their taxes and insurance and moving into foreclosure. Okay, so what they do is they set an amount on the first 12 months of how much you can get out in the initial disbursement, and then in month 13, the rest of it opens up and you could access whatever's left on the line. We do a financial assessment. We have to be sure that you have enough based on your pensions, income, or whatever income you're receiving monthly. We look at your debts. There has to be an amount available for minimum family subsistence that you have to meet based on family size in the home. Okay. So we have to do this residual income calculation, kind of like in the old days with FHA and in the current days with VA. We have to look at income, take out expenses. Do we have enough left for minimum family subsistence based on family size and geographic location? Okay. There are non-borrowing spouse protections where let's say you have someone who's 65 and the spouse is 55, and there's a protection for that non-borrowing spouse because they're not 62, they can't be on the loan. Should they want to remain in the home after perhaps one of the spouses has to move out of it or passes away, there are protections for that spouse that they may be able to stay in place, and that due and payable status is deferred as a result. The line of credit is secure and will continue to grow regardless of the home value. And the non-recourse feature, and we're going to get into that in the next slide, what that means. Okay. If you get a reverse mortgage now, are you paying anything even if you don't use it until later? So yes, you have closing costs in securing the reverse mortgage now. If you have sufficient equity, that could be included in that reverse loan. If you're not paying anything on it, you never have to pay anything on the reverse mortgage, but any balance that is on the reverse mortgage will grow over time, no matter how low. So let's say, just to give you an idea, closing costs on reverse mortgages are about 5%. They're higher because the upfront mortgage insurance premium is 2% on the value of the home. So if you figure 2% for that upfront MIP plus regular closing costs, maybe 3% in Virginia, that's if you had a $400,000 value, your closing costs are going to be about 5% of that, or $20,000. So even if you had no mortgage on the house, you might have a balance of $20,000 on the reverse loan. Okay. Just to kind of give you an idea of that. Okay. You can use a HECM to buy a home. So you can upsize, downsize, right size into an ideal home. Move closer to the grandkids is the number one reason for the reverse mortgages that we see. Again, keep more of your retirement assets. So rather than that borrower who's going to sell their $700,000 home or $1 million home, move to a less expensive area and pay $500,000 in cash in retirement, maybe they use a reverse mortgage and hold back some of those proceeds and keep them invested over here, right? So why use all the cash? Why not have, again, that cash working for you over here? Maybe have a small reverse mortgage over here. Again, you're not making any payments on it other than the taxes and insurance. But then look at it as what's the best use of my portfolio? You know, do your kids really care about getting this house should you pass away, or are they more concerned about the money that they might get as instead of the house? Okay. Again, that someone asked, are there any mortgages other than the HECM? Yes, they are private. Usually certain banks come out with them. They are conventional, they are proprietary, typically for property values that are over $1 million plus. Maybe we can't get it FHA approved and they live in a non-FHA approved condo complex. Some of them will allow younger than 62, and there could be avoidance of that mortgage insurance premium on the conventional side. So there's not a ton of them out there. Again, they're not all national. There's pockets of them across the United States, but they are there. We can search them and see if something would apply. So let's talk about what happens when the loan matures. What creates the maturity event? Well, you want to sell the home. The reverse mortgage has to be paid off, just like any other loan, right? You're in title, you're in control, you're selling the home. We get the payoff balance on the reverse mortgage. You go to settlement, the reverse loan gets paid off. Same as usual. If you decide to transfer the title out of your name to somebody else, that will trigger the due and payable clause. Okay. The last surviving borrower moves out of the home permanently. That will trigger the due and payable event. You default. You stop paying your property taxes, right? You're getting foreclosure notices because the property taxes haven't been paid. That's a default, just like it would be on a regular home loan. And the last surviving borrower passes away. So how is the balance repaid, right? This maturity event happens. So the loan is not yet due and payable. That means that you're in your house, you can pay as much or as little toward the loan balance each month as you wish, or you can make no payments at all other than your taxes and insurance. So that's, you're in the house, you're in the reverse. When that maturity event happens, the loan is satisfied with the sale of the home, regardless of what the house is worth and what the balance is owned. That's what non-recourse means, okay? The sale of the home will always satisfy the loan repayment obligation, and neither the borrower nor the heirs will be personally liable for any balance deficiency. That is what the mortgage insurance premium is for. Okay? If the house is underwater based on market value and has to be sold, you could just give it back to the bank and they'll take care of it and you're done. Heirs don't have to worry about a thing, right? But what happens if the heirs want to keep the home, right? So let's talk about that. If there's equity left in the property and the heirs want to keep the home, they can pay off or refinance the loan balance, right? Just like anybody else. They're now owners of the house. Maybe they want to refinance out of that reverse and keep the house. So they could do that. They can sell the house and pocket the profit. They could do that too, right? If they don't, if they want to keep the house, right, but there's no equity left in it, one protection on the HECM is that they can buy that house with a short payoff at 95% of the home's appraised value. So go back to our example. House is worth 400,000. They owe 450. The appraisal comes in at 400. They can buy that house at 95% of 400,000. Okay. So huge protection for the heirs there if it's just a family home and they want to keep it in the family. If there's no equity left, they don't want to deal with anything. They owe 450, it's worth 400. They sign a deed in lieu of foreclosure and they walk away from the home. They are not liable. Okay. Is everybody clear on this? Because this is the strongest piece of protection in this product. Okay. I don't know where you would find something like this as it relates to heirs anywhere else. And again, why fair rate? We really are just passionate about being a top reverse mortgage lender across the country. Okay. We are in the top 5 as far as a leading lender in reverse. And it is really just about educating this segment of the population to think about their retirement differently. Think about where they are, where they want to be, what they want to do. You know, my husband recently retired in January, and someone said, you know, okay, you've worked 40 years to get this t-shirt that says I'm retired. You know, I worked 40 years to get this t-shirt that says I'm retired. Well, it's conversations like this that say you work 40 years, you know, to enjoy however many you have left while you're in good health. This is a way to do that and not keep putting off that date that keeps moving, it seems, before those maximum benefits will kick in. So I really hope this resonated with a lot of you today, but I'm certainly here if you have questions.
Couple of questions in chat.
How quickly does the loan need to be paid off upon the death of the owner? So typically 6 months. You have one extension beyond that that might be available to take it out up to a year. Okay, but the notices will come within 30 days of the death of the last owner. While the estate is going through probate, I don't know the answer to that. I think it would depend on if there is a definitive as to who owns the property. You know what I mean? So if there was a question about who owns the property, or who is able to make decisions as it relates to the property, I would really defer to an attorney on that question. I can't imagine it would be any different. I don't think whether it's a reverse loan or a forward loan, it makes a difference to that question. I
I
think
can
it's
answer it.
I think
My
it's an
attorney
attorney
was
question.
very clear about this.
Mhm,
That's why we put everything in a trust. Doesn't go through
mhm.
probate.
Yeah. Yeah, it allows you to take action, you know, pretty immediately.
Our trust is very detailed. So it's
Mhm.
and I've already, you know, when Steve died, believe me, I have I utilized those forms, you know, somewhat questioning in my mind a few one, you know, I kind of wondered, even though she told me certain things, right?
Mhm.
But it all worked out
Mhm.
exactly the way it was supposed to.
Mhm,
So I'm telling you, she was right.
mhm,
What do I know, right? She was
mhm.
correct.
Right, right.
Well-
Any other questions? Please feel free to unmute.
I also wanted to share something that I just heard yesterday about trust. I don't think people are aware. When you do have your house in the trust, your home insurance should also be in the name of the trust. If something happens to your home, in order for it to get insured, I think that's what I heard.
I better check
So I
on
think,
that. I don't have it.
Yeah, I'm
yeah,
gonna have to follow up on that. I hadn't heard that.
Yeah, that's a good one. And that's good that you're bringing that up because,
Yeah,
I know
yeah,
with my home in a trust, they made the insurance company USA made us put the home insurance in the trust,
yeah,
under
yeah. I'm
the.
going to call them because
So,
USAA, I don't know
mhm,
if they did it or not. And I remember
mhm,
sending stuff to them, but I
mhm,
don't know. They've dropped the ball a couple times on things. So now that
mhm.
you're bringing it up, man, I better make sure because that's a little bit scary. Okay.
I did have a follow-up question. I kind of like start typing and then hit
yeah.
send too early. Um, so you do a deed and lien and you pay off your house on your
Mhm,
reversible. If
mhm.
any money left over, do it go back to your family or siblings or whatever, or how that works?
Absolutely. So you control it. So let's say the will provides that heirs receive the property. You can
Right.
contact, as the realtor, you sell it or anybody else, whoever the realtor is selling, you're acting the same way you would as if it was a different product, right? You still want time to sell the reverse. The only difference is, right, in a forward loan, you have to make mortgage payments. You have to continue to make those mortgage payments while you're selling that house. In a reverse,
Okay.
you're not, right? That's why there's a timetable involved.
Okay.
So, but you can sell it and the payoff balance is going to continue to accrue up until it is
Hmm.
paid off, but it's no different than anything else. You're still the one in title. You get
Okay.
all the money out of it as long as you clear it. It's only in the case where there is no money to be had, you would just sign a deed in lieu and let them take care of it. Why would you spend $1 on marketing the property if it's underwater,
Okay. Thank you.
right?
Hmm. Hmm. Yes,
I
I
did,
understand.
I did that a number of years ago. I had a brother and sister whose mother had died. They had a reverse mortgage. They had 90 days to pay it off. We were able to get the house ready and get multiple offers on it. And the only holdback was that the title company held back a certain amount of money for 1 year because they wait in case there are any liens against the property, or you can pay something up front and avoid that, the rest of the money being withheld.
That's a
I
new
never
one.
heard. Yeah, I never heard of that before. Like I said, we sold my mother's in December. There were no funds held. She received her funds just like anybody else on a payoff, and there was nothing held. So that would be strange to me unless there were like mechanics liens or they were getting the house, things happening on the house to get it ready for sale, perhaps.
There were
Mhm.
no other liens. It's just, I guess, that the title company, since they guarantee everything, holds back a little bit of money until the rest of the year, until a year has gone by, but they got the rest of the funds. Brother and sister got the rest of the funds, or they had the option to take, I don't know, some percent more. And it's like an insurance policy, I guess. And then they could get the rest of the funds
Is that an
distributed.
FHA reverse?
I never heard of that. Never
Yeah,
heard of that at
I've never
all.
heard of it either.
I would be questioning title upside and downside. Like,
Yeah.
you want to hold my money?
But
What?
maybe some of the old, you know what I mean?
Yeah,
The
could be.
other people do reverse mortgages. I would never
Yeah.
do one out of doing FHA. It's the most protective. But think about it. How long has that been available the way it is now?
Yeah, it's definitely not what it was. I
Uh,
mean, even when my mom did it in 2008, it's much better than that period of time. where we are now based on like me looking at her statements and some of the fees that you were charging monthly and things like that. And it's difficult because my mother took a lot of pride in not having a loan on her house, but I would say to her, we're either going to give you money monthly or you're going to control your expenses. And the one thing a parent doesn't want to do is really impact their children, in their lives. But I said, don't even look at the statement, just put it in a drawer. What do you care? Your kids are going to take care of everything if something happens to you. Just don't look at it, just enjoy your life, do the things you want to do.
Is there a large upfront? Is it just like a regular FHA
So
or
it's
reverse mortgage?
so it's
Use the high points.
yeah, so your FHA mortgage insurance premium is part of your closing costs. Okay, so think about like on a purchase FHA for a first-time buyer, you're financing that FHA MIP and it's 1.75%. On a
Okay.
reverse, it's 2% of the value of the property. Your property is valued at $1 million. Your MIP is $20,000 in closing costs.
Okay.
Plus your closing fees. And I always figure 3% for closing
Okay.
fees. So I figure 5% on the value of the home as a worst case. And people will say that's really, really high. I'm like, and I will say, compared to what? There isn't a product that works like this. Okay. There isn't a product where you can say, I'm going to spend $20,000, let's say on $1 million property, I'm going to spend $20,000 in closing costs on this loan. But by me using this reverse mortgage, for my monthly needs, whatever I need it for, I get to keep my assets growing over here, at a much higher rate than me liquidating out of those assets and paying tax on it. That's where, like, in conjunction with your financial planner, this is where you need to have your conversations, because I can tell you financial planners absolutely love this. Not because you're saying you get to keep my money with you, but by saying you have another vehicle that you have options with your money, in the coming years. It's all about the options, in my opinion. If it's a great time to take gains, you're going to take your gains and reinvest them perhaps in something else and use your reverse. But like I said, people with varying income, like realtors, love this program. I know one of my realtors, as I mentioned, uses this, says, Kelly, I don't know what I'm going to make every year. Some years are better than others. So I want a reverse mortgage. I don't want to make a mortgage payment. When it comes to October or November, I'll decide. Where was I at the beginning of the year on the balance? Where am I now? What did I make? What do I want to pay down on it, if anything? Okay. Because I always say, get to November if you're going to make a payment on it, just because it could be captured on your interest statement. So you get that in time for year end when you file your taxes the following year.
Hey, Kelly.
Yeah.
Kelly, yesterday, I was at a opening of a groundbreaking for a new casino in Virginia.
Mm-hmm.
And one of the retired city officials took me to lunch.
Mm-hmm.
And he has he estimates probably 400K plus in equity in a home that's paid for.
Mm-hmm.
And his question to me was, Bruce, I want you to find me a ranch style home, and I'm going to use the equity I've accrued
Mm-hmm.
to purchase this home.
Mm-hmm.
And so my take to him was, tomorrow I'm going to be on Cindy Bishop's reverse mortgage class. So hold on and let me get back with you.
Plus he can buy more house.
Yes. So this is an individual who worked in local government. I believe he was there so long that they still had a retirement versus 403
Mhm,
uh, uh, B. So he
mhm.
probably has a pension. But we now have to find the best means of allocating all of this accrued equity.
Right, right.
And
I think you found it.
yeah, yeah. So
Yeah.
I'm going to hopefully reach out. I had reached out to you, Kelly, a while back
Mhm.
regarding, but I'm going to reach out to you with this young man. I'll probably just email us and maybe try to set up a call because I think this is a vehicle that could be, he could clearly, and I know you explained, but he could take a portion of that equity that he's accrued and not have to make a monthly payment ever again
Yeah.
on a
So
new
the
home.
goal here would be you're going to sell his house and you're going to sell his current house and you're going to sell him a new house he's going to move into. And he's
Yes.
not going to pay for it 100% cash. You're going to put an FHA loan on it, reverse, and he's not going to make a payment.
Yeah, I'd save some of that money too.
Right.
Yes.
It's
And
tax-free
dependent
money.
upon his age and, whatever the cost of the new home is, et cetera, we're going to calculate what that max loan amount is. If his intention was to pay cash just so he doesn't have a payment, this is an alternative to that and still not have a payment. You know what I mean? Like if the goal is not to have a payment, why use all of your cash this way? You could set up a reverse loan and pay down on it when you want to. I think of it
Yes.
really as a money management tool. I have some people, like I said, my mother never made a payment on hers in 16 years. But as a money management tool, I'd be looking at maybe in my brain, I just don't want my loan balance to exceed a certain amount. So I'm going to be watching my other investments and take my gains when I can, and then keep it at the balance I want to. But in the meantime, I've used it however I saw fit over the course of that timetable and didn't have a payment.
Thank you guys so much.
You're
Oh,
very
my
Great.
welcome. Quality of
pleasure.
life, man. That's really
Yeah,
what it's about.
exactly.
Do we get these slides? This is
Yeah.
Deborah again.
Yeah, she'll send it to you.
Okay.
Yeah, I'll
All right.
send it to everybody, sure.
All right, guys. Thanks a lot. And don't hesitate to call Kelly. Let me tell you what, there's a lot of companies out there that do this, but they don't do it well. And I mean, I can say that because you know, I run a school, so I vet a lot of people over the years. And a lot of the people nobody that I except for Kelly, nobody does it with her expertise. What I find is they refer it to somebody else at their company. Their company does it. I don't like that. So, I mean, somebody might, it's okay, but Kelly will cross the T's and dot the I's, and that's the way she is. And she's the person I'll go to when I
Yeah, and
do
I'll
this.
also, like in my email signature, it lists out all the states that I'm licensed in, which is pretty much all along the East Coast plus California. But if you have someone out of state that is interested, I know a lot of people at my company who can help. So while it might not be me because I'm not licensed in that state, we have lots of great people doing reverses all across the country. So
Well, they're so well trained too, because we had
yeah,
that other gal before
yeah,
you started doing it, and oh
yeah.
my gosh,
So
it's
even if
amazing.
they're relocating, you know what I mean? And you've got a reload client that you're sending out, it's worth considering that if they were going to pay cash, and that's what a lot of people say, oh, I'm just going to pay cash. I don't want to deal with it. I'm like, is that the best use of your money? Because again, do the heirs care about getting the house or do they care about getting the money? You've got to think about that. Will my kids care about taking my house off my hands, and dealing with selling the house? They would rather, if the house is underwater and they could turn it back over to the bank, well, guess what? That other money is already invested somewhere else. So, I think everybody just has to think a little differently. And once you get past that, you can make some good decisions.
And Kelly and Cindy, I will say this too. Uh, you don't talk a lot about this, Kelly, but the young the young guy I spoke with yesterday, of course, he's an elder to me. His reason for selling his house is not only downsizing, but now the house is of age. And so there are maintenance related issues. So you buy a new home and you sort of defer any of those maintenance issues. You get new roof, you get new appliances, and so all of these things bode well with clients who are looking at new construction.
Absolutely. And that's a very key feature, right? Of the FHA loan. Think FHA appraisals. You've all had FHA appraisals come your way. So now they're downsizing to a newer property that's been updated. You're not going to have any issue with your FHA appraisal, right? One thing when people want to age in place and use a reverse, they worry about the condition of the property. Maybe they need the reverse to do the upgrades that are needed. The downside of that sometimes is if the property is in such disrepair now and there are safety issues, we're going to require that those be remedied before we can close on the reverse. So it's not a slam dunk if the property is in disrepair, right? You've got to think about how an FHA appraiser is going to look at the current property and its current status. Does it have peeling paint? Does it have handrails? Does the basement step have a rail going down? Do you have cracked windows? Doesn't have to be perfect, but you've got to take care of those safety items if you're going to consider a reverse.
Awesome. Well, thanks everybody.
All right.
And
Thank you
Kelly,
so
make
much.
sure, yeah, and make sure you send that out. I sent you the
Will do.
roster. So yeah. All
I'll
right.
get that out
You guys
this
have a great
afternoon.
day. Thanks for
Have a good
attending.
one.
Thanks.
Thank you.
Bye.